Hello, good afternoon, and welcome to today's Capstone special webinar, Current Trends in M&A Business Valuation. My name is Brent Holliday. I'm the Marketing Manager for Capstone. I want to thank all of you for joining us today. Now, before I turn things over to our host, there are just a few items. This webinar can be taken for a CPE credit if you like. Capstone is registered with the National Association of State Boards of Accountancy as a sponsor of continuing professional education on the National Registry of CPE Sponsors. State Boards of Accountancy have final authority on the acceptance of individual courses for CPE credit, and complaints regarding registered sponsors may be submitted to the National Registry of CPE Sponsors via the website www.nasba, that's N-A-S-B-A, nasbaregistry.org. Now, during the course of today's webinar, we're going to ask 3 poll questions. There's no right or wrong answer, but if you would like education credit for today's webinar, simply put your answers to these questions in the questions feature of your GoToWebinar dashboard. You do need to answer all 3 questions in order to receive credit. If you yourself have a question for either of our presenters today, you can also use that same question feature on your GoToWebinar dashboard to get that over to us, and we'll do our very best to answer. And finally, we do have a brief survey at the end of the webinar when you exit. If you could kindly fill this out, it does help us continue to make these webinars relevant, valuable, and as effective for you as possible. And now with that, I'm going to turn things over to our host for today to introduce our topic and our very special guest speaker. And our host for today is the founder and CEO of Capstone Strategic, Mr. David Braun.
Thank you, Brent. I appreciate that. Welcome, everyone. I'm delighted to have this special webinar today on valuation. And I want to give just a brief background on it before I introduce Luann. But this webinar came out of, frankly, many of you reaching out to us and saying, hey, tell us more about what's going on valuation. What are some of the trends that are happening? How should we be thinking about how we're valuing companies? And this came about because many of you have been, as you're looking at acquisitions or potentially divestitures, and you've been noticing this rising interest rate environment, you've noticed that there's been some pressure and some kind of natural friction in terms of how people are looking at and valuing businesses. So while we have our valuation team here in-house, I thought it would be really helpful for all of you to hear from a leading expert on this. And I'm just very delighted that Luann Serafin with Grant Thornton is able to join us today. Luann has a wide experience in valuations, both for ongoing entities as well as for bankruptcy, for intellectual property, for technology businesses, government contractors, for M&A due diligence. I mean, just a kind of a wide range, and of course, has a very strong pedigree, having gone to the University of Virginia for undergraduate, and then the NY Stern School of Business for MBA. She's a chartered financial analyst, and I just have to say she is just a real pleasure to talk to and hear her talk about what is happening in the industry. So Luann, again, privileged that you're able to join us today. We're honored to have you. I know folks are very eager to hear what you have to say. So let me turn the floor over to you, and we look forward to it. I just want to mention one more thing, because we're doing a little bit differently today. We are doing the 3 poll questions, so those of you that want CPE credits can get it. But rather than do them through the slides, we're going to do them verbally. And so you'll just type in your answer in the question box, and that way we can comply with the NASBA requirements. So just a reminder on that. But anyway, Luann, thank you again for joining us today. And let me turn it over to you to talk about this very timely subject of valuations.
Thanks, David. Hello, everyone. So David asked me to talk about trends in valuation. And so I know at the top of everybody's mind really is what's going on with the economy and how is it impacting valuation. So I put together the agenda here. So we're going to first talk about the economic impact on valuations. And then the question was really also, what's changing regarding valuations and methodology. So I'll talk about a couple of things there. And then looking at some industry trends that we've noticed, and I've definitely gotten some input from some of my colleagues here at Grant Thornton. And then lastly, just kind of looking at some M&A trends. So we'll go ahead and get started. Okay. So the first thing for the economic impact on valuations, the way I looked at it really was, what impacts the valuation? The first thing really is looking at overall discount rates. And the second thing was forecasts. So those are the big areas where we're seeing impacts from the economy. My first bullet point here is really on risk-free rates. And I think it really is telling, looking at the graphic that I put on here, about how the risk-free rate has really increased 11 times since the beginning of 2022. And it went from 0.25% to 5.5%, which in my lifetime is the biggest time I've seen such an increase in such a short period. So this has definitely had a big impact for us when we do our calculations of discount rates. And at Grant Thornton, we tend to use CAPM approach, looking at WACC. One of the next inputs that we looked at was the equity risk premium. One of the sources on that in the industry is Kroll, and we have seen a decline from 6% to 5.5%. And remember, that's, how's the industry or market as a whole, what is that premium over the risk-free rate? And so that has been declining, as I'm sure we're all looking at our 401k balances. So you can see that there as well. Betas have definitely been more volatile. It really depends on the industry though. And that's going to be the theme of the day, is it depends on the industry. I think that's been having, depending on what industry is, things have been impacted in different ways. And we'll talk about that a little bit more. And then lastly, the cost of borrowing obviously has been increasing as credit risk has increased and overall rates have increased as well. So next, just looking at what impacts the forecast, really there's, revenue growth, and then the second thing really is expenses and margins. So looking at growth, if you look at different industries, it's kind of been a mixed bag. You see, big impact I've seen has been the commercial real estate market. Was hit hard with so many people not returning to work after COVID. And then the home building market, I've seen several clients that have been impacted, by the high interest rate environment, and also certain geographies within the U.S. have been hit harder, especially the West Coast and South, where there's been hurricanes. That also has had an impact there. One area where we've seen a big boom has been in the construction of manufacturing facilities. So that industry's seen a ton of growth, and we'll talk a little bit more later. But overall, when I pulled the different partners that I work with, I think we've all agreed a lot of the forecasts have been tampered down from the 2021 levels due to the uncertainty in the market and also the rate of inflation. Grant Thornton produces a CFO survey, and so we had one for the second quarter of 2023 as well as a third quarter. So I'll talk about a couple highlights there. The second quarter indicated that the CFOs see the key to growth really being investment in people and technology, and AI being at the forefront of that. So those are producing opportunities for growth, but I think it's going to be a little bit, a little while before that can kick in and actually see an impact on those forecasts. Next, looking at expenses, I don't know how many times I'm going to talk about inflation, but inflation obviously has been pretty high, especially through the first 2 quarters of 2023, and that's really driven up the cost of goods in the market. Also, supply chain disruptions actually continue globally. It's not just from COVID. Certain areas of the supply chain in different industries are continue to have problems. And that leads to increased costs in many industries, whether people are trying to come up with workarounds, to solve those supply chain issues, looking at different products, that sort of thing, or just expenses as a whole, related to the supply chain have increased. There also is a labor shortage out there, especially in industries such as the restaurant industry. I'm sure you guys have all been to dinner and noticed things take a little bit longer, and a lot of it's because that labor shortage. In the restaurant industry, which for us is under the retail sector, has been dramatically impacted by that. And then, of course, certain industries can pass those costs along to consumers, which are leading to more expensive costs, but other industries aren't able to. And so that's where we're seeing a reduction in margins. And in one area, people are trying to cut costs and optimize costs is through AI. And they're using AI really to try to eliminate some of their labor issues. They're trying to increase efficiencies in processes in order to cut costs. So in the third quarter 2023 GT CFO survey, a portion of CFOs who projected potential layoffs in the next 6 months actually rose 10%. So we did see things fall during 2023 with a lot of uncertainty. But there's still people who are nervous about the overall global economy and the impact on industries.
Hey, Luann, we had a question that came in from one of your earlier slides.
Okay.
And it was about the equity risk premium going down while the interest rates have gone up.
Yep.
Can you explain, because the question was, it seemed counterintuitive that the equity risk premium would be going down while interest rates are going up.
So the equity risk premium really takes the overall returns in the market and subtracts the risk-free rate. So what we're seeing is those returns are not increasing with the increases in the risk-free rate. And so that's leading to a compression of returns over that. So the premium over the risk-free rate in the market actually has been declining. And you can see that with the overall stock market. If you look at the S&P index or one of the indexes, you can see there's been quite a bit of volatility in the market, and that overall has led to lower returns.
Thank you. While I've got you on a little bit of a pause, how about if we use this time for our first poll question?
Sure.
Because we have to do 3 of them, so let's get one down.
Okay.
So for those of you that want CPE credits, just make sure to answer the poll question. And the first question is going to be, do you think the economy is going to be better or worse in 2024? So just, do you think the economy is going to be better or worse in 2024? And if you can just put your answer in the question box, then we can satisfy NASBA requirements. So there'll be 2 more, but that's the first one. Back to you, Luann.
All right. So kind of ending the economic impact, I also found some other interesting points that came out of Grant Thornton's third quarter CFO survey results. And some of them are kind of contrary, but there's been a rise of 7% from the previous quarter who are pessimistic about the U.S. economy. So in our second quarter, I think people felt like it was going to get better in the third and fourth, but then once the third quarter came, I think that people have been revised that, and the reasons they cited were factors impacting this is the continued war in Ukraine, and then now especially with war in Israel and a lot of global uncertainty right now. Interestingly enough, the percentage of CFOs that predicted growth in net profits over the next 12 months actually jumped 9 percentage points over the second quarter to a 6-quarter high. So that I found very interesting, and hopefully that a lot of cost-cutting measures, I think, are what is being attributed to that one. And then more than 3/4 76% of the CFOs predicted net profit growth, with more than half saying the organization will grow profits by more than 5%. But I think overall, based on what we're seeing and from our clients here, is that the economic factors are really leading to lower valuations across many industries. But of course, like I said, there's always some exceptions. And, you know, once we get into the industry overview, you'll see kind of which industries are kind of faring better than others. Okay. All right. Next section I know David was asking about was any changes to valuation methodologies, which is always interesting. But you know, when you kind of take a step back, there's always been 3 real valuation approaches. And when I look at it, the underlying methods haven't really changed much. And when I look at where I do see the most changes, and that's, you know, what I'm hearing more out of our complex financial instrument practice, and usually they're kind of subtle changes that are led, you know, by firms like ours in the industry on how things are done. And that gets to be a little esoteric probably for this conversation. But looking at where we do see changes, it certainly is with those more complex financial instruments as people kind of refine the way we look at things. And then when I look at like what changes in our valuation models, I really attribute a lot of that to accounting and tax changes. You know, every year when I look at, you know, the new models that we produce, you know, certain things that, you know, definitely stuck in my mind that had a big impact recently, or more recently, was the implementation of lease accounting. And then previously the interest rate deduction limitation, you know, that led to some changes in kind of how we do stuff. And then also now looking at R&D and having to capitalize portions of R&D also have had an impact on there. I also think that, you know, some changes, while it's not methodology changes, I think that, you know, AICPA and the PCOB, they're really applying more scrutiny to year-over-year changes in methodology. They're really looking for consistency in application to future measurement periods. The other thing that we've noted is just more quantitative support for assumptions. And I think that has led to a little bit, you know, those of us who do valuations and have the auditors review them kind of lead to more questions. And I think the driving factor of that really is getting documentation right and substantiating it. There will be a new AICPA guide that will be coming out shortly, really looking at what AICPA had put out on the mandatory performance framework and putting that more into a guide, so it's a more universally accepted methodologies. And really, like I said, it's really focused on documentation. A couple of things that I did note from my colleagues really are changes to how the discounts for lack of marketability may be calculated or applied. Really, I think one area that we've noted is that, you know, it's pretty common practice now not to apply a discount for lack of marketability for common stock if the interest also holds preferred stock. And then there is the thought prevailing that transactions automatically include discounts for lack of marketability, so there's no need to duplicate that and put another discount for lack of marketability if the transaction is like your leading price indicator. And then if you use common stock volatility to get DLOMs, and you're also having to calculate an option value, one thing that we see is sometimes people use equity volatility instead of the common stock volatility, but there really needs to be an apples to apple comparison. So that's another item that has come up really in the last year of items that, you know, need to be addressed, or if we see some mistakes, that's one area. And then as I talk about documentation, we see that there's there's a leading for things to be more quantitatively justified. So one example is in, your discount rates is the company specific risk premium. And one way to do that is, showing a de-risked forecast and seeing the difference in the rates that were, internal rates of return that are generated. So I don't know if you have any more questions, but that's all I had on the valuation methodologies. Otherwise, we can jump into
another question that came in, Luann, was you mentioned earlier at Grant Thornton, you guys are primarily using the CAPM or capital asset pricing model versus, you didn't say this, but I'm going to fill in the rest of it, versus the BUM method or build-up method. Can you explain that a little bit, especially given sort of the uneven volatility, because the question was around why use CAPM versus the BUM method?
Ever since I've been at Grant Thornton, we've definitely used the CAPM. It's, the build-up method, nothing wrong with it. I see it all the time. And when I look at other audits that I get and our audit clients and their valuations, I think it's just was a preference that Grant Thornton had. I don't think there's any real reason why. So, I generally find when, we're looking at audits and we use our standard methodologies with CAPM versus a buildup, I don't really feel like we're getting any, like a materially different answer. Yeah. So, yeah.
Awesome, thank you.
Yeah, no problem.
Can we go ahead and use this time for our second poll question so we can get a little bit ahead of the curve?
Sure.
All right, let's get the work out of the way while we have this. So our second poll question is, well, let's stick with the theme that we're talking about. Do you prefer the capital asset pricing model or the build-up method, CAPM or build-up method? Get a little technical here for folks. This is, again, for those of you that need CPE credits, and we will only have one more poll question, so we've got two out of the way. And then just, again, put those in the answered questions or questions button. And then let's turn the page and start talking about industry trends.
All righty, here we go. So the first industry I selected, I think, is the financial sector, just with interest rates. I thought people might be interested in that. And I have seen a significant impact. I've seen, originations and prepayments are down, but interest income and expenses are up. For those that are using CECL, I found recently they've, taken the losses, because you're looking at a lifetime loss, seen a lot of losses taken currently, which then reduces the amount of losses that are taken over the long term. So you're seeing a short-term application of the losses being recognized, but then you see in the forecast long-term losses decline. And it's been interesting, looking at the financial services companies we deal with is, when they think recovery is going to happen. And, everyone's different. Some people think 2024, some look better in 2025. But I guess we're all going to have to wait and see. But the public company multiples that I pulled are from this source is PitchBook. They're trailing 12-month. And because this is a mixed bag of companies, banks, asset managers, insurance companies, etc., I pulled both an EV to EBITDA, but price to book also is really kind of the metric most of these trade off of. Here, just to get an idea of where you're at, I don't think they look overly different than what I've seen in the past. I think for, I think these multiples seem fairly stable compared. But, it has been a mixed bag, depending on where you are in the industry as to whether valuations are up or down. Next industry I chose to highlight is the manufacturing industry. This is one that I do a lot of work in. There's definitely been a recent surge in the U.S. manufacturing industry, spurred by government incentives and a desire to onshore manufacturing. These incentives have taken the form, in the IRA and the other tax incentives that are out there have really, spurred a lot of manufacturing. You also have certain areas of investment, specifically the semiconductor industry, as well as the alternative energy, which also includes EVs and the EV supply chain. And then two programs that I know I do a bit of work around for clients is Department of Energy's, their loan program office. They've got two loan programs. One is Title 17, which is focused on the alternative energy, and then the Advanced Technology Vehicle Manufacturing program, which is focused now really on EVs and EV supply chain. And we're seeing a lot of activity in the EV battery space in that particular supply chain. And then with the CHIPS Act, they're focused on bringing the semiconductor industry back on shore, which definitely is going to be a challenge. You know, they have had notice of funding rounds. They've had 3 now. The first was focused on the semiconductor manufacturers. The second was the supply chain in like tier 2 companies. And then they bifurcated the supply chain with a big inflection point being $300 million or more funding that they're requesting. And then more recently this September, they opened it up to companies within the supply chain that are in the 300 to 20 million range. So overall, manufacturing is in the middle of a longer downturn, which started with COVID. Output fell 43%. Really due to quarantines and large global supply chain disruptions. These entities typically trade as a multiple of EBITDA. There was a dip, you'll see on the next slide. There was definitely an increase where, you know, 2021, or where you see 2020 where COVID hits, it goes down dramatically and then back up. So there's been a bit of volatility and then a dip that is looking like it may recover soon, but there still remains a lot of economic uncertainty. So, and I don't know if anyone really agrees when they think the market's going to come back entirely to the pre-COVID levels, but let me flip to that next slide so you guys can see this. Yeah, so you can see where in COVID, everything dipped down, multiples dipped down, but then 2021, M&A market went crazy, and then tapered way back in 2022. And then we're looking at the first half of 2023, where multiples start to recover to 10.2. And then ultimately in the last third quarter here, they were up to 11 times. And then of course you can see the deal volume here as well, where you see the dip in 2022 and then, you know, projected recovery over 2023. So the average deal value within this sector rose substantially actually this past quarter, more than doubling in the last 6 months. Next industry I know Grant Thornton does a good bit of work around and people are interested in is the pharma industry.
Hey, sorry to interrupt, but we have another question that came in. Can you go back to the slide, the manufacturing one? The question was around size. Do you see a difference in valuations based upon the size of the company? And can you comment on that?
Yeah, so I think actually the larger, more, so it's going to depend where you are within the manufacturing sector. The sectors that are really hot right now are in the EV supply chain, and as well as semiconductor industry. Those multiples tend to be higher, and the deals at this point are, you know, the average deal value is increasing. And one of the sources I looked at suggested that it may more than double in the next 6 months. So while deal values have been down, they're definitely recovering in the deal size.
So that makes sense because those are considered to be high growth areas, right? And they're going to continue to get a lot of federal funding.
Yep.
What about for smaller
tax incentives? You know, a lot of them go for, I mean, what are we? We're in 2023. You've got another 5 years of those. So just kind of seeing how that all plays out. People are trying to monetize those as well. And looking especially in the energy sector, monetizing those energy, production tax credits, and it's definitely
anything with clean energy and renewables and clean energy. What about regular manufacturing companies? What I mean by that, companies that aren't necessarily in one of those kind of higher growth.
right.
There was for example, there was some talk this morning on Squawk Box on CNBC about companies that make, and this was by Raytheon, companies that make component parts, that are being used. That's still a supply chain challenge, but those companies that are in that, call it $20 to $200 million size range, are you seeing much, or what are you seeing in terms of valuations for those kinds of companies?
I wasn't able to really pull them out separately from the data, but I do have some manufacturing clients that, the ones, for example, like I said, in the home sector, those multiples are not, they're not going like gangbusters, like a semiconductor or an alternative energy or EV battery. They're still struggling a bit. They're having issues with the supply chain still. And even some of those have been impacted by weather. You don't always think about the hurricanes if you're not impacted by them, but it has had in the South and in the West, has had significant impacts. So
just another reminder that we have to be careful about using some of the broad brush, multiples and things like that, because you got to really dig down deep, right? With the
you really do. You need to break it down further. If you're really like looking at a deal, you got to really pull those companies that are specific.
Thank you.
Yeah, no problem. Okay. Next, we're looking at pharma, and so talking to our pharma experts at Grant Thornton, overall consensus were that valuations were really trending down from 2021 to 2023. And actually in 2023, we've seen a bit of write-offs actually. For those that, several of their pipeline, have had products that have been delayed. Overall market valuations are down. Pharma was one thing where SPACs were interested, and so now SPAC investors are being very careful and cautious with pharma investments because the public comp prices are down, overall multiples are down. And then we've definitely seen where the public and the private, there's a bit of a lag between pricing. And so, talking to the experts at Grant Thornton, I really learned that, 6 to 18 month delay for the private investments versus the public. One interesting bit is there's a new PE VC guide that came out that's adding some clarity on how investments should be valued. And it's allowing a high weight being placed on common stock equivalent scenario. And this brought some consistency across the valuations we've seen at PE firms. I have a bit of data on this one as well, where you can see, as of 2022, the total number of pharmaceutical M&A transactions fell from 143 deals in 2021 to just 109 for the entire sector. And then the average EBITDA multiple for the industry is sitting at approximately 13.2. Experiencing a slow rise in 2023, analysts we saw attributed the rise in valuations to a stockpile capital that many pharmaceutical buyers were holding on to during the bull market, anticipating a down cycle. So they were able to use some of that capital. Additionally, there's now a better understanding of legislation affecting this industry with the IRA, which allows the buyers to more accurately assess risk and reward of acquiring a pharmaceutical company. And the number of pharma M&A deals is expected to increase over 2023, but not necessarily the multiples that are being paid. And what we are seeing is that strategic buyers are more likely to offer higher multiples for pharmaceutical companies than financial buyers. So, okay. Next, I spoke a little bit about it with the construction industry. Residential construction has slowed due to the economy, interest rates. Also, the supply chain in certain subsectors is still impacting the construction industry. We do see accelerating infrastructure projects. AI technology is being employed. There's also a lot of emission reduction efforts that is driving M&A activity. And typically, construction companies are valued using EBITDA multiples and to a lesser extent, revenue multiples. And so we can see here it's really dominated by strategic investors versus financial investors. And here we have the EBITDA multiples and revenue multiples. Revenue multiples seem fairly flat, but you can see the decline in the EBITDA multiples through 2022 with a slight improvement through the third quarter of 2023. Inputs continued, so in August of 23, input prices continued to increase month over month. It was driven by increased energy costs as oil producing countries continued to limit the oil production. And it will definitely be interesting to see what happens, especially with the war in the Middle East right now, what happens there as well. And then since July of 2022, investments in building domestic manufacturing facilities surged 71%. And again, that was largely due to the funding that's being provided by the 2 federal loan programs that I mentioned previously. And like other sectors, buyers in the space tend to be more strategic versus financial. Private firms have poured over, I mean, this is amazing, $511 billion into initiatives ranging from chip fabrication, electric vehicle battery plants, to clean energy and biotech infrastructure. And this onshoring trend in the U.S. is further emphasized by several upcoming projects, each worth, over $1 billion. I don't know if you've seen the different announcements from Ford and GM and how much money they're spending on these manufacturing facilities.
Hey, Luann, another question came in about these loans. Can you comment from your experience and Grant Thornton's experience on the average size of the loans and how long they're taking? Have the loans actually been getting funded, and what's happening with that?
Yep. I definitely have seen several funded. The size of the loans are really gonna depend. Here we recommend that you wouldn't really go to a loan program unless you need like 100, and this is for Department of Energy, you need at least 150 million required for your project, whether it's retooling a facility or building a new facility. Now for the average size, I normally see them, 750 to 800, but if it's a multi-project loan, so if they're building multiple facilities, that's where they're getting into the billions of dollars. So.
And you are actually seeing the funding happening. It's actually been not just on paper, but companies are actually getting the funding.
Yes. Yep. So, LPO is obviously more advanced. Those programs date back to early 2000s. So their loan programs much more advanced than the CHIPS Act, right? Because the CPO, the CHIPS Program Office, is newer. I know they've taken other people from other loan programs throughout the government have come to help the Department of Commerce. And so CHIPS Act, while LPO is issuing loans, CHIPS is also, they're issuing grants, they're issuing loan guarantees, and they're also issuing loans themselves. And they, announced that they would be issuing grants first. And so, they have one program dealing with all of those things, whereas at Department of Energy, they have a loan program office, and then they have various initiatives throughout the DOE. For example, it could be clean hydrogen, and they could announce a grant, or there were grants announced, I believe, at the end of maybe fall of last year that were for batteries. in the battery supply chain. And so that itself is a different office. So you definitely have seen, I've seen a lot of grants going out. I've seen loans gone. I know the Ultium project with GM, that was a significant multi-billion-dollar loan that closed with LPO. You know, they've announced several closings of those loans. They've also announced what's called conditional commitment. And so that means that the federal government's committed to provide those funds. The businesses still have to, you know, sometimes have some conditions before they can close the loans. And generally that's just getting their equity in place, but the government has otherwise pledged those.
And then I know during COVID, we had to, when we were valuing businesses, we had to take into consideration PPP loans. How do these loans impact valuations on these companies?
You know, so honestly, not many that I've looked at had PP loans, and many of them were forgiven at this point.
And then how about these? How do we think about these kinds of loans? Are they loans that have to be paid back? Are they impact? So they're going to show up on the balance sheet as a liability.
Yes.
So they are going to impact. They are going to impact valuations.
Yes, they definitely will. You know, the good thing is they're at favorable rates, you know, slightly over, you know, treasury rates versus what can be lent in the market. You know, the Department of Energy, or just the federal government in general, takes a first lien on all the assets. You know, whether it's, you know, looking at, you know, the renewable side's more project finance, the ATVM side's more corporate loans, where they take an all asset lien. So it is, you know, they're not planning on forgiving them. You know, I think like any program, there's always some kind of risk that, you know, an entity may fail. But I think at this point, everyone's so invested in making sure that these things are a success, that, you know, the ones that, you know, are getting loans and closing, like you're seeing progress, you're seeing facilities built. And it's really moving along.
So another question that came in, you obviously sparked some interest here. Another question that came in was around automotive companies. Do the UAW strikes impact valuations? Or how do they, I guess would be a question.
Yeah, you know, I haven't really studied like how they've impacted, but if you look now, you know, anything from like component parts, I don't know if you've tried to take your car in to get fixed, but I know my husband did recently, and it was a small part in the door that needed to be fixed, and it took months to come in. And so that's impacted their service ability to service vehicles, their ability to produce and get, you know, new vehicles out on the line. So all of that is slowing down their profitability and really detracting from it. So it does create like a blip of uncertainty and decreased valuations there.
Do you take that into consideration? Because part of the discussions are around the UAW wanting to have labor unions for the EV production. Many of them, I guess, are not, you know, like Tesla, for example. Do you take that into consideration in valuations, that there's the possibility that a company may become unionized? How do you think about that from a valuation standpoint?
I mean, the big four auto aren't any of my valuation clients. I do know them and I'm very familiar with them, but I think, you know,
think about the tier 2 or tier 3 even players.
Yeah, the suppliers. Yeah,
exactly.
I think that's where the risk is. I mean, when you think about a GM and Ford at this point, they probably can absorb that, right? But it just depends, because it's going, you know, depends where they end up with negotiations on those strikes as to what will happen. But yeah, you definitely have to consider how long the strikes are going to go along. Now, as for the EV, I think there's really a push not to have unionized labor like Tesla in order to be competitive in the market and, you know, really compete. I think that's something that, you know, they were not wanting to have a unionized labor market, but, you know, it's, you know, just depends. I mean, historically, our automotive industry has been unionized. So I don't know if it's just a matter of time before it is, but then, I know they're very concerned about, their place in the global market.
Good point. Thank you.
So next, in this one, I was able to like break down the industry sector here because I think it varies wildly across the sector depending on where you fall. Restaurants are really struggling. Labor costs and decreased discretionary spending have, really impacted them. Yet like hospitalities and hotels have done better as people began to travel post-COVID, and business travel has really been increasing. So where you're seeing some of the challenges here, it just, kind of depends. So you look at like physical retail stores, like CVS and Target, they had suffered with a lack of people shopping in stores. And then, in the last year or so, there's been a big rise of theft being a major concern for these retailers. And a lot of companies, are concerned about that and have, in areas where they've had uncontrollable theft have actually closed down stores. They're still plagued by labor shortages. You do see a lot of AI coming into these type businesses to try to, really remedy that problem and cut costs. But several companies, are looking at their physical locations, deciding, being a little more choosy about, what entities to close down, or, some of them are just forced to file bankruptcy. And you saw that with Bed Bath & Beyond. Like I said, automation and AI is a major focus area. The valuation multiples are typically based on EBITDA multiples. But oddly enough, you have those struggling entities, but if you look across the sector, they're expected to see growth of 4 to 6% in 2023, which is, kind of below the trend, but it's better than what's been expected. Like it could have been worse, I guess. And so these are some of the multiples that, we've been seeing in the area, where of course like food and grocery being lower. All right. Next is the technology sector, which is, I think has been kind of fascinating because after 2019, there was a spending bubble and the demand in the technology sector really slowed, valuation started to fall, and then profitability really mattered again. And so this sector as a whole, I think, saw a big change in cost cutting, severe layoffs, and ultimately they were able to rebound. And you'll see that in the graph that I have in the next slide. But, they understood, the technology sector is central to all that we do. And we see the biggest area of growth is within AI. And there's really a need to develop resilience in the supply chain. And so it's really creating opportunity for technology to have a role in that. And overall, the pace of deals since the third quarter of 2022 continues to be slow, but it's in line with the broader deal market. And so we can see here that you can see the tech market, dips, comes back in 22, dips again at the end with a lot of the uncertainty. And this is where you see a lot of the cost cutting happen. And then again, since January of 2023 has been back up. So it's starting to definitely bounce back up. And then here's the multiples. You see the multiples really peak there in 2020, but they didn't really decline that much. I mean, about a turn from 2020 to 2021, with some recovery in 2022, and then down a little bit in 2023. And then that, I'm ending with this one because I thought this was fascinating, just kind of looking at like what the fastest growing industries are in the US here. And you can see the hybrid and electric vehicle manufacturing is up there. Peer-to-peer lending platforms, investment banking and security intermediation in the US. Subprime auto is big. People are buying more used vehicles. And then, you definitely even see here with the travel, people are tired of staying at home and the discretionary spending they do have, they're wanting to get out of the house and actually travel. And I thought that was pretty fascinating. And then oddly, I'm not sure what's driving this, but cattle and hog wholesaling in the US. And then of course, after looking at the 10 fastest, I decided that we should probably look at the 10 fastest declining ones in the US. It's still up here with iron and steel manufacturing, still having a lot of like supply chain issues, natural gas distribution, paper, people aren't using as much paper, sewer and pipeline rehabilitations, invoice factoring, and some of these I thought were fascinating, chicken and egg production. And this, I thought it was strange that the semiconductor manufacturing was here, but I think it's just a matter of time before the CHIPS Act really sees an impact on this space, because you really just started getting people, they're in that program now. And to my knowledge, I haven't seen any loans issued. I think their process is actually taking a bit of time, and it's a good bit of time probably before they work all the kinks out of that program. But I think that's kind of been standard for any of the programs at the federal level. And then let me know when you want to do your third and final question. But
all right, we got a couple more minutes and then we'll do it.
Okay, all right. So lastly, I'm going to cover some M&A trends that we've noticed. Overall, the global M&A value is down 44%, and that's across everything, looking at like Bain studies in the first 5 months of 2023. And, really SPACs have kind of fallen out of favor here. What we're seeing is, corporate M&A and the financial investors are still, moving. PE firms, what we see is really strategic buyers is where that's at. But I do see in the PE space that PE firms are making smaller, more add-on type investments. But here, and of course, as we've said, the macroeconomic environment, interest rates has really led to the uncertainty. And it's really complicated some deal making, and it's made people more cautious. And so deals are taking a lot longer to close. They're being a lot more careful. There's a lot more back and forth. There's deals that don't even go to close more often than what we had seen previously before 2022. We are seeing in our space more asset deals, especially for those under 50 million. And then we see several of the equity deals actually take a tax election to treat them as asset deals. We've seen an increased use of earnouts and contingent consideration, which is making, kind of echoes people being more cautious. More strategic investors versus financial investors are completing deals, because I think financial investors are more willing to walk away from a deal. PE deals, like I said, tended to be more smaller add-on type deals. But, I know Bain here thinks that deal making is likely to resume faster than many anticipated, but they really favor better prepared buyers and sellers. So, people who are more sophisticated, I think in the process are able to get deals faster.
And that kind of goes in with what you said. Consistent with talking about strategic investors. When you talked a couple slides earlier about the profitability, people are focused on, how can it be more profitable, and obviously adding some strategics are going to help that. Well.
Really looking for synergies and cost savings and just kind of ways to make more out of what they have.
Let's take our last poll question, and then we've got a couple more questions for you and from that have come in. So our last poll question will be, do you expect a recession in the next 24 months? Yes or no? Do you expect a recession? I'm going to ask you that question too, Luann. What are you guys at Grant Thornton thinking about in terms of, we kind of keep talking about this. We've sort of been talking ourselves into a recession for the past year, I think. I keep telling people, stop watching the news. Just get on with business. You have plenty of business in front of you. Stop looking behind you on the news. What are you guys seeing? How are you thinking about the economy in the next year or so?
I don't know that Grant Thornton's actually put out a big view on the economy, but I mean,
has Luann put anything on the economy?
The side of things, I think I'm a more cautious person, kind of conservative in nature. So, I mean, I'm not going to lie, I've definitely seen deals taking a lot longer to close. In our business and space, things have definitely been down, and people have been more cautious with their money. Not really spending money when they don't have to. So, where that will end up, I think kind of depends also on interest rates and, getting inflation under control. People are still buying houses at 8% mortgages when, I'm sitting here at 3%. So I'm not getting rid of mine anytime soon.
Exactly.
I think we just have to kind of wait and see, but not overreact.
What do you? Another question came in around due diligence, because I know part of your practice is also around due diligence.
Yeah.
What are some of the things that you're seeing now in terms of requirements on due diligence, either for the audit or for banks, for lending, or Q of E, quality of earnings?
Yeah. We have a big demand for Q of E. I've actually seen probably more Q of E on smaller deals than what I'd seen in the past. Because a lot of times, our diligence practice, after there's, working on the buy side, a lot of the work will come over to our valuation side. So I have seen the deal sizes go down. Now, yeah, I just, do I see more banks doing diligence? Yeah, I think everyone's more cautious, right? I mean, even the government, I have seen, as they've been going through this process, and they're very motivated to get these different technologies and manufacturing facilities up. But I have seen the process, if you're not a big four automaker and have deep pockets, they're doing a lot of diligence on these loans. And I think people in general are being very careful. Making sure everything's collateralized and, there's a lot less risk.
You mentioned that you're seeing things take longer. What is your timeline that you're seeing now for transactions to get completed?
I think before, like, our diligence team would come in and, maybe 3 weeks or so after you'd see something, and now I almost think it's been doubled, to be honest. But I think what I've noticed more are there's a higher percentage of deals just not closing as well. So that kind of impacts it, because it doesn't always get to me then if it doesn't close.
Yeah, that's right. What about on the sell side? Have you been seeing any trends on the sell side in terms of pipeline development and companies that are looking now to sell?
Well, I feel like from a sell side perspective, we're seeing more companies kind of get rid of non-core assets or non-core business lines is what I've seen more of from a sell side. Whereas before, you might see a wholesale of a company. It's really, they're kind of cutting costs and getting rid of non-essential assets and kind of focusing on their business plans more. I don't do much with our sell side M&A group, so I don't see everything, but overall, that's kind of my impression from the clients that I have who are, they're divesting of certain assets versus wholesale sales.
Great, awesome. Well, Luann, we are out of time, but I want to thank you again for your vast knowledge, you and your team, Joe Burke and the due diligence side, and everyone over there at Grant Thornton. We really appreciate it. We think very highly of you and your colleagues at Grant Thornton, and we appreciate, and I know our audience does as well, appreciate your expertise, and don't be surprised. I suspect we will have some folks that will probably reach out to you with some questions as a result of this, but I want to thank you again for being here.
It's been a pleasure, and always happy to answer questions.
And let's turn it over to Brent for our wrap up and logistics on making sure we do everything right from a housekeeping standpoint.
Okay.
Thank you so much, David. And thank you, Luann, for being an absolutely wonderful presenter today. Great presentation. Wonderful job on you for you both with both the content and the Q&A. As far as folks who were looking for CPE credit for today, thank you for answering our 3 poll questions, and we will get those certificates emailed out to you within just the next few days. Just another quick reminder, we will have a survey pop up at the end of the webinar for all our attendees. I know we see a lot of those these days, but those really do help us both in terms of keeping these discussions on topics that are of interest to you and framing the discussion and going out and getting wonderful guest speakers like Luann Serafin we had today. And just a quick reminder, our next Capstone webinar is going to be on the 16th of November. That is part of our M&A U series. Title of that is the M&A process from LOI to the ink is dry. So please do plan on joining us for that. That and all of our upcoming Capstone webinars can be viewed on, if you go to our homepage, capstonestrategic.com, just simply click on the webinar button, the webinar option on the top of the navigation bar, take you right to that, get your registration information and see our upcoming topics. So with that, thank you again to David, thank you again to Luann, thank you again to all of you for joining us today. Hope you have a wonderful rest of your day, and we hope to see you right back here again soon for another Capstone webinar. Bye-bye, everyone.
Thank you.
Bye.
Bye-bye.